Ready, Freddie?
Yes.
Good morning, good afternoon, good evening. Welcome to the Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend, as always. And today we're talking about tax optimization when you are owning real estate. And it's going to get meaty. We'll tell you that right now. Buckle up. This is Heather's episode. She lives, breathes this with her clients. I'm just here for the ride. So this is a masterclass in real estate knowledge, so get ready. If you haven't been here before, you got to like, follow, comment, send it to your mom, put it in the boys in group chat, subscribe. I probably said subscribe twice, and do everything you can to make sure that we are a bigger platform than we were last week. If this is your first time here, don't worry about doing that. Make sure that we've earned it. But if you've been here before, you know what you're expecting, so please do as you're told. You're expecting a disclaimer right now. You're not going to get it. It's going to be at the end.
What?
I know. Mixing things up.
Wait, are we allowed to do that?
Legally, it's fine. As long as we put it in an episode, we're all good. Yeah, mixing things up on you, Miss Townsend.
Like it. I'm like, wait, are our legal bases covered? Compliance covered? Okay, check. Great. At the end.
Yeah, did you just tense in your body there, compliance-wise?
Yeah, because they put the fear of God in us.
Yeah, I ignore mine. Because it's me. And our first segment, it's me where you get to know us professionally. The second segment is called Let's Dive In, where we get into content. The third segment is all about questions, and then we wrap it up with highlights where we talk about us personally, and we got some good stories for you, so hold on for those. So our first segment has no name because we keep changing it. So Heather, how you doing?
I'm doing really good. I had a really good past week, Dave. My clients are on fire. Many of them are record earnings, getting promoted, buying their dream houses. And I know the world is a little unstable right now and it feels unstable, but my clients are thriving and it's exciting. And I got to celebrate one of my clients. I was actually invited to one of their parties to celebrate one of their milestones. And that was really special. And I forget because I live on Zoom most of the time, right? But it was really nice to get out and actually see some clients in person. And honestly, the last week, I probably saw 3 to 4 clients, which is in person.
That's cool.
That's a lot for me. Maybe 5. It was a lot. And I was like, wow, this actually really gives me good energy, I noticed.
I agree. Seeing the clients that you help in person really gives me energy too.
Yeah. What's going on with you?
I'm gonna throw a scenario at you, and you're gonna tell me if I'm out of my mind with my reaction or if it's justified. Let me tell you the story. So one of my clients, mom passes away. Mom has an advisor at a broker-dealer. If you don't know what a broker-dealer is, me and Heather do not work for one.
But yes.
Enough said.
Enough said. I already know where you're going. I mean, I think this is the fiduciary duty, not to interrupt you, but to answer your question, yes. If one of my clients passes away and someone else is inheriting the assets, I'm going to honor my client's wishes and help their loved ones, not only just from a fiduciary standpoint, but an ethical, good-hearted, helpful place. But This is where our profession gets a really bad name.
It does. I even came across and said, look, these aren't my forms. I will help you fill them out as best I can, but just know that these aren't familiar to me. But if I was you, I would push back hard on your mom's advisor and say, I need your help. My mom just died a week ago. Can you have some grace and just help me fill out the forms that are in French? But I don't know what to do.
Broker dealer. That's all you had to say. I mean,
we're getting through it. So for anyone who is grieving, there's a lot of people out there who can help you. And if they're not there to help you, they're not to be in your life. All right, that aside, let's dive into the content.
Taxes, real estate. I had to, can I just say, we had to divvy this up into 2 parts. It's meaty. We've learned our lesson. We've learned our lesson the hard way. So
what? People don't want to listen to 3-hour podcasts? Come on.
Yeah.
All right. So you're gonna kick us off because this is your meat and potatoes. You're gonna eat on this one. You're going for it. I'm here as your guide.
All right. I want you to ask questions because taxes are so complicated. I want you, if I'm not clear, Dave, tell me. Ask for examples,
100%. I will act like a client here.
Okay. But the first one, primary residence. You know this one. We're going to start it off easy. So primary residence, Capital gain exclusion, meaning no taxes on your gain, up to $250,000 if you are filing single, $500,000, so $500,000 if you are filing married filing joint. You will have had to have lived in the property for 2 of the last 5 years.
This is when you're selling the house.
When you're selling the house.
Okay.
So, I would say a majority of the population doesn't pay taxes on their primary residence because you also get to step up basis. So your cost basis. So not just what you bought it, but let's say you paid real estate commissions, you improved the home. If you have receipts and all of that, so track it, you get to increase your basis. So very rarely, I would say, do I prepare a tax return where there is a gain from a primary resident. Not because of what they bought it for and sold it for, but because of the improvements that they've put in that normally help step up that cost basis to not make it a gain.
I think the frequent time you see this is when people have bought a house in the 50s and they've lived there for their whole life. And it's now 50 years later, and now they're selling it and it's in a market where it's really appreciated.
But what, for 50 years they didn't improve it? Like no improvements?
Well, the house price is in the 50s. You're buying a house for $60,000. Now it's worth, who knows?
Yeah, I guess if you
$6 million.
I mean, I get, yes.
You know what I'm talking about.
Yeah. So that one's pretty easy. That what I would say is the traps I see from, the love of social media and all these tax strategists and people that give these ideas to people is convert your primary residence to a investment property and then go buy your new home. Why would you give up $500,000 if you are married of a tax-free gain? That doesn't exist really except inheritance. I was trying to think, is there another tax-free gain out there? It's not coming to my mind. Maybe there is something, but point being is it's rare. Tax-free gain? Come on.
And this is a simple one. There's no complicated hoops you have to jump through.
I think if you want to buy an investment property, buy an investment property. One thing that I will say on primary residence is, let's say, like right now, the Phoenix real estate market is softening. Things aren't moving. So some of my clients that have wanted to buy a bigger house, this is a good opportunity to get in, right? They are capitalizing on this opportunity. But it might not be the best time to sell because prices are a little depressed, or you're not going to get your best price. I could see renting it for 2 or 3 years, but still stay in that 5-year window until the market comes back, rent it for maybe 2 years, and then sell it. But still get that capital gain exclusion. Don't go through those 5 years unless the market is just so depressed for the next 5 years. Like if we had a 2008, different situation. So that's kind of just me, primary residence thoughts. Are you kind of in agreement, Dave? We disagree sometimes on housing, I've found.
I definitely agree. I agree with everything you said. If you're looking to investment property, this is nothing. Do not mess with your primary house to do this.
Yeah.
There's too much at stake.
Dave and I agree, everyone. Yay!
Oh, where's a soundboard when you need it? We need the claps.
We do. Okay, now my energy, you're just going to watch. Fix and flips.
Getting angry, I can already see.
Okay. This is not my favorite. This is not my way that I like people growing wealth in real estate. I am very, very open about this. 1, I think it's extremely risky. And 2, from a tax point, it sucks. I can't be any more blunt from it. So first of all, if you're fixed and flipping, you're trying to do it in less than a year. So now you just got yourself in it's a short-term gain, your ordinary income. You can't depreciate it, right? And here's the part where many people don't know is if you're not intending to buy a house for investment, long-term investment, and you do multiple fix and flips, the IRS terms you a dealer, and you now have to pay self-employment taxes on fix and flip. I just want that to sit right there. That's a good, what is that, another 15% of taxes on top of ordinary income? Like, why?
So you'd pay that on your gain if you're considered a dealer?
Yep.
Now, I've seen realtors do this. Like when the market gets slow and they're not finding too many deals, they will buy a house, flip it to get that extra income. Is that different than like your regular person who got 200 grand from somewhere going out and trying to do a flip? Like, are they classed differently?
No, because I had a realtor do it. and I had to prepare that. Realtors are classed differently for like loss limitations. That's going to be another episode, but no, like not, you're a dealer. Like that's what it is. And so you can't 1031 fix and flips. That's another one. I love the idea. What I want to say though is I love the idea of I get renovation. That can totally add value. So I'm with you. But I like the
Brrr.
strategy. Buy, renovate, refinance, repeat, right? Like, but you're renting in this process. Like you're renovating, renting.
Okay.
I don't
So you're doing it to improve a rental property. Like your intent is to rent this out.
Yes. Don't flip. And also flipping is risky, right? Like what if the market moves on you? Then what?
Yeah. There's a lot of serendipity in these flipping shows that happens, especially the ones in California. It's like, oh, we bought it, and then we went over budget by $1 million, but the market went up and we made X amount of profit. I'm like, but did you? Or is this just for a TV show? Because I guarantee the rest of the nation probably didn't have the same amount of luck as you did. Look,
and it's timing though, and it depends on the market. I mean, you and I have had this conversation. Right now, the Chicago real estate market couldn't be any different than what's happening in Phoenix. It is.
It started to slow, but it's been very different.
It's completely drastically different, right? And so, and it can turn at any moment. You don't know. And so, I mean, maybe people in real estate can start seeing it. I mean, I'm not selling real estate all day, so maybe real estate professionals can start seeing, okay, things are turning. Fix and flips, too risky. I don't think there's a problem if you are going in and being like, hey, I'm either going to determine if I'm going to flip this thing, but if the market turns on me, I'm okay renting it, and you're willing to take that risk, then fine. But I think people get in a lot of trouble where they have to flip it because they've taken on too much debt or hard money loans or whatever to do this. I think now let's get into, you are buying up an investment property and you are going to rent it out. There is this beautiful thing called depreciation, which can be very good from a tax standpoint, but you need to listen to the next episode because you can be limited on deducting losses, but I'm not going into that today. Okay. So generally we'll talk bird's eye view. So on a residential property, you can depreciate over 27 and a half years. So if you bought it for $1 million, you can depreciate 27 and a half. Now hold on. It's not as simple as that. It's the tax code. You can't depreciate land.
So what is depreciation for? If I'm a first-time real estate investor, what benefit is this giving me?
So that's a deduction on your tax return. So
I can write that off against my rent and not pay taxes on the rent?
Yes. So or even if it's available for rent and you haven't been able to rent it, but it's available for rent, it's a deduction. Let's say you buy $1 million property. Let's just say for ease, 200,000 is land. So then the building value is 800,000. You would divide that by 27 and a half. That is your depreciation per year. So commercial buildings though, office buildings, things like that, 39 years. So
that's less of a deduction if it's the same property value, residential versus commercial. Okay.
Yes. Okay. So then there is bonus depreciation, which is accelerated depreciation. And Dave, do you remember those videos, I think they're still doing it, but where people are buying G-Wagons on Instagram and they're like saying, big deduction. Ooh, I can deduct it all. Well,
yeah, I have 7 6-ton vehicles in my driveway because I was able to bonus depreciate all of them.
Yeah, right?
I drive one a day for work per week.
In 2022, it was 100%. Now it's only 40% of accelerated depreciation. But in these properties, if you have a recovery period of less than 20 years, so think things like furniture, fixtures, appliances, flooring, landscaping, you can accelerate that depreciation. Not the building portion, right, where you're having to do it over 27 years or 39 years, but anything that's different, you can. So, and interior renovations on non-residential buildings, commercial buildings, those can be bonused too. So that's really good. I had a client do that for a commercial property and got a lot of bonus depreciation. So
is bonus depreciation pretty much anything that's not the brick and mortar of the business?
I'd have to understand the definition, but for ease, I'd say yes with a question mark. I'd need to define brick and mortar, but yes.
Gotcha. Okay.
So these are all great, right? So going back to this though, with depreciation, there is a gotcha with depreciation.
No, don't say that.
It sounds so great. I'm getting all these deductions that I'm not even having to spend money, right? You bought the thing, but then you're just continuing getting these deductions, right? Then when you go sell it, do you know what happens, Dave? Not many people know about this.
This is an IRS gotcha. Tell us more.
It's called depreciation recapture. So if whatever you depreciated, the IRS wants back when you sell it, up to 25%. Most clients are in 25%. So let's say you depreciated the building 100% or $100,000, you have to pay 25% depreciation recapture tax on it, $25,000 of taxes.
So if I'm going to buy a property and depreciate it, but then have to pay taxes with depreciation recapture at the end when I sell it, what's the point of doing depreciation?
This is where it gets really interesting with tax planning, right? This is why tax planning is so important. You do not want to sell a rental property in a high tax year. You want to accelerate depreciation, maximize depreciation in high tax years. Going into a low tax year, that's when you want to sell.
So if I can manipulate my income down to zero, that's when I want to sell the real estate that I've depreciated.
Yeah. I mean, and you need to plan for it. I can tell a story. One of my clients sold a rental property recently, and they really didn't make very much because the market shifted. They didn't lose, but they really didn't make anything. And I said to them, okay, great that we have all these, the cash back, the proceeds, we need to put $30,000 aside for taxes. They got upset with me. They were like, what do you mean? I didn't make anything. Why do I have to put, $30,000 aside for taxes? And I was like, well, because you depreciated it for the last 3 years with bonus depreciation. And so you brought your basis down. Like, even though if you bought it for $1 million, right? If you depreciate it down to, I'm making up numbers right now, but 850, that's your basis. Like, even if you bought it for $1 million, sell it for $1 million, your gain to the IRS is $150,000 because you depreciated it $150,000. You have depreciation recapture. And they didn't believe me. Then the CPA resaid the same thing, and they were like, oh, okay.
But they actually got some tax benefit while they were depreciating it, but they just didn't get the plus side of we made a gain on the sale. So they actually did benefit, right?
Yes. And technically, depreciation recapture, I mean, if your ordinary income tax bracket is 37%, let's say, right? And depreciation recapture is only 25%. If you got to offset some of these losses against your ordinary income, you're still up.
Sure. You got that 12% delta right there. Okay.
But it is the gotcha. I think people, when they have investment properties, look at, I bought it for X, I'm selling it for X, that's my gain. It's not that simple. They forget about depreciation recapture. So having a CPA and a tax strategist or someone who can plan ahead so you understand the tax implications before you sell an investment property is really, really important.
This is a lot.
I know. And here's the scary thing. Not a lot of realtors understand taxes. And not that I'm saying that they should as a CPA, because they're not. But I feel like if you are selling real estate, I hope they are telling their clients, go talk to your CPA before you do this.
Right.
Because if you've held it for, fine, 3-4 years, if you didn't bonus much and you just depreciate over that 27 or 39 years, you might not have that much depreciation. But let's say you've owned the property for 10 or 15 years and you have a big gain.
Mm-hmm. Ouch.
I know. Okay, anything over the depreciation recapture though, if you have more gain over that, I do want to say then it's long-term capital gain rates. I want to add that in. If you have more gain over, what you depreciated, then after the depreciation recapture, 25% up to all the depreciation you took, anything over that is long-term capital gains of, somewhere between 0 and 20% depending on your income. That's The one last thing I want to mention with depreciation, though, is going back to bonus depreciation, that accelerated depreciation.
Mm-hmm.
If you are in a really, really high tax year and you're buying a rental property because you have all this extra cash, do a cost segregation or consider it, because this is where you can, piece out those. There's cost segregation specialists. They will go to the property and they will piece out, hey, these are the furniture we can take out. These are the fixtures. This is the flooring. This is the appliance. Like all those pieces of the property that could be bonused. That's basically what a cost seg does. So, but get a specialist for this, and just really know your bigger plan, because again, now you're depreciating more, right?
Because like you said, it's the internal stuff for the bonus depreciation, but no one's going to know what that is.
Well, and
if they're just someone buying an investment property.
Some of the stuff, landscaping, fencing, I even think. So it's interesting. Also, I will say some clients that are in really high income, but the properties they're not hugely expensive, let's say. I have a great cost seg specialist, and he's so honest, and he's basically told me, like, if the client's basis in the building is, $600K or less, it doesn't make sense for the fees to pay for a cost seg. Like it hasn't really made sense, right? So, if you have a basis of $1 million, it starts to get really good. And maybe that will change if bonus goes back to 100, but right now it's still only 40%.
Sure. Are they expensive then?
They can be, yeah. I mean, I forget off the top of my head. I forget if it's like a flat fee or a percent. I normally go with the flat fee. Something in my mind is telling me somewhere between like 6,000 and 8,000, but I don't remember. All right. That's real estate and taxes. So I hope I didn't make anyone fall asleep, but Heather likes to put her pretty bow on. This is very nuanced, and, really with real estate, it can be a good investment, but taxes can eat away your profits, right? Like taxes is expensive. So just make sure you're planning, understanding, and being strategic of when you sell these properties, all of that. And then, lastly, of course, there's the 1031 where you can defer the capital gain. You need to have, say the word, Dave, I can never say the word. You need to have a
intermediary.
Yes. A good real estate agent will know one. Financial advisor, CPA, they will know one. Speak to them before you put the property up for sale. Have a plan, and just also have a plan, because now you're just rolling that gain down the road.
You're giving away tips for our next episode. Shh.
Okay.
You're talking about selling. People aren't selling in this episode.
Okay.
They're buying and holding.
Okay, they're buying and holding. Okay, that's my bow. That's my bow, Dave. I hope. Do you feel like you know more about real estate and taxes now? How did I do?
That was good. If ever I decide I want to buy a piece of rental property, I'm going to sit with a real estate specialist CPA first before I ever do that. We are going into what would you do? These are the questions based on our content. Question number one for contestant number one. Whenever I say question number one, that always flips my mind to, there's a dating show called Blind Date, and there's contestants 1, 2, and 3 behind a wall, and they ask questions, and it's question number one for contestant number one. Anyway.
You and TV.
I bought and flipped a property 4 months ago, and I'm now selling it to buy another one. The market's gone up, and I expect to make a profit of $75,000. What do I need to look out for?
Whether you're going to qualify for a dealer, and even if you don't yet, be careful, because you're definitely paying ordinary income taxes on that gain. You only bought it, you've only owned it for 4 months. So if you're in a high tax bracket, that's expensive.
If you bought it 4 months ago and the market's gone up and you're making a $75,000 profit, how hot of a market are you in?
Well, that's where the flips scare me, right? If they're hot and that's happening, it can also reverse just as fast. And that can't happen in COVID. That was happening, at least in Arizona. I guarantee you that was happening, depending on the purchase price of the house. But that was happening. It's probably happening in Chicago on properties of a certain value.
I did hear a real estate professional in our market talk probably last week, and the trends that happen on the coast and in Texas eventually go into the Midwest, and the market's slowing on the coasts, and it's now coming into the middle. Our hot market's going to finish.
I have another client that's been wanting to buy in California for a long time, and in a really, really hot market, and opportunity is definitely presenting itself finally. Patience wins. Patience wins. It does. All right. Question
All right,
two.
this one's a quick one for you. Question number 2, how do I find a cost segregation specialist? Will my realtor know one?
Hopefully. If not, then your CPA, financial advisor, someone will know one. Get a good one, but yes.
Yeah, reach out to a financial advisor or CPA specializing in real estate, and I think that's going to be your market.
For some reason, I thought you asked if a realtor will know a 1031 specialist. I don't know why I heard that, but on cost seg, actually, I think it's doubtful that a realtor, maybe a really, really specialized realtor who specializes in investors would have one. Otherwise, I think it's more a CPA or a financial advisor would know who one. Definitely.
Yeah,
CPA.
if you're doing residential sales to people buying a house, why would you know a cost segregation specialist?
Unless you specialize in investment property. Yeah. Okay.
All right, we're flying through these today. Question number 3. My CPA says I should buy my office space instead of leasing for cost savings. What do they mean, and is it accurate?
Well, okay, I'm going to talk through this so people can follow my thinking. So if you're leasing, it's still a deduction in your business as rent, right? However, if you buy an office space, you're going to get depreciation and the rent is going to you. I mean, depending on if you can afford, but I mean, I said in the previous episode, if you're going to continue to stay in that office space and you're already paying the rent and you have the cash and it doesn't strap you in any way, I do like the strategy of buying the office building. I'm not against it because you're adding the depreciation basically, and then the rent is going back to you. I mean, just really the down payment and the interest. You got to see, like, can you take that on?
I actually know a couple of advisors who have done this. One bought the office building that they're still in and rents out office space to other people. And then there was another advisor in COVID. There's a village near us that it's all houses that have turned into offices. So he bought the most rundown one he could and then rehabbed it. He's on a main road now, so he gets a lot of visual traffic there. But he came to me and was like, yeah, this is like half the price of my house because it was COVID. No one wanted this beat up building. And yeah, now he owns his office space. So it was smart of him.
Really curious what happens with commercial real estate. And of course, I think it depends on the type of commercial real estate, just like residential real estate, right? It's like market, location, all those things matter. But one of my clients does own their office building, but it hasn't really gained anything in 10 years.
Okay, interesting.
You know, like because think of COVID and then office space started not being in certain markets. I mean, I don't know if San Francisco is coming back, but if you think of San Francisco, for example, where my best friend lives, I mean, it's like now a dead town. I don't know if it's back since COVID, but for years after COVID, it was very dead in the financial district. No one went to the office anymore. So I don't know. I don't know with office buildings. I mean, I think if you're going to stay again in that office building for some time, you might as well. But if it's for a short time, again, risk. I don't know.
All right, we're going into our final segment. It is called Highlights. All right, this is our personal win or personal highlight of the week. We've actually had a break in recording for 2 weeks, so we could have a lot of stuff to say here. So Heather, what's going on?
So I'm in the creep of construction, like the cost creep.
No.
It's kind of a highlight though, because I'm leaning into, I go by this quote, once you settle everywhere. And I tell my clients that. But to be honest, since having kids and just growing this business, I really haven't honored that as much as I have in previous times in my life. And I think I've suffered from that. So I'm coming back to that again. My interior designer was like, we were going to redo our master vanity. Okay, not very expensive because we're not changing structurally anything. But she goes, Heather, if you redo this vanity how you want to do it, because I'm not settling on how I want to do it, she goes, the shower's fine, but people are going to be like, she redid the vanity and didn't redo the shower. So now I think I'm redoing the entire master bathroom. I mean, we already have to put new flooring in, right? And then the flooring isn't going to match the tile in the shower because we have a walk-in shower. And I'm like, okay, I'm waiting on the quote for it. My husband's reaction was not great. He might have cursed when I called him. Now then he saw the design with my ideas and now he's on board. Typical. But he hasn't seen the price. He's like, I want to see the price.
Mm-hmm. Everyone loves the designs until they see the price.
I already gave him though, because a lot of my clients are busy in real estate and they're remodeling my homes. I mean, my clients are just really busy right now. I have but enough data where I gave him a number. I was like, I think it's going to cost X. So we'll see if I'm right. I'll let you know.
And then you pat him on the butt and said, go to work, boy. You got to pay for this. Get out the door.
What's going on with you?
Well, I took 8 days out the office to go and see family. Just Sarah's brother and his kids. We were helping him out with childcare. And then we went to a week-long baseball tournament in Tennessee for my 12-year-old. I was not expecting what it was. It was a beautiful facility. It was like 5 turf fields. If you don't play baseball, you have no idea what I'm talking about.
Turf is. I live in Arizona. I'm following.
Okay. I wasn't talking to you. I was talking to viewers.
Okay.
But it was played in the backdrop of the Smoky Mountains. So the view...
The Smoky Mountains, I hear they're like stunning. Are they stunning?
Yeah, I will send you pictures. But it was baseball fields, and if, it was a pop fly ball up in the air, it was like, oh, there's the Smoky Mountains, and there's a baseball just flying through the air. Like, it was gorgeous. It was very hot. And then we came home, and I was like, all right, let me just ease back into this work week. And it was just not an ease back into the work week. And then I got reminded today, and Sarah was like, I'm flying to DC today. I'll be gone for 4 days.
You forgot?
I knew it was there, but then Monday and Tuesday kicked my butt in work. And so I woke up this morning, it's like, your bag is packed. You're gone.
Every time Alex goes away, I have the utmost respect for single parents. It is hard.
100%.
It is hard. I mean, it's already hard doing it with a good partner. Doing it alone, utmost respect.
Well, then I look at our calendar, and we've got my one son comes back from camp tomorrow. So he had the baseball tournament, flipped his laundry. He left for camp the next day for 6 days. And he's not done that camp before. We had 1 or 2 pictures sent through. I have no idea what his emotional state is. And he's a mama's boy. So we will find out tomorrow. And then we have a baseball tournament on the weekend. Our garage floor was finished. They did it wrong, so they have to come back and completely grind the floor back while I'm not in the house to figure out what they're doing and, work and the rest of the stuff. So I agree with you. Props to single parents who are trying to handle this all by themselves. And I can't handle 3 days.
And you're in remodeling with me too, I'm hearing. So you're staying in your house and remodeling it to love. We are.
So the funny part of it is I move at speed. Like in my business, if I want to try something, I don't wait. I'll try it. If it works, fantastic. Go for it. If it doesn't work, it didn't work. Put it down. Move on to something else. I have taken that mentality into my house. So Sarah was like, we do need to get new windows. I'm like, great. He's coming tomorrow. Make sure you have some time free for the consultation. And she's like, okay. We got back from Tennessee on Friday night. And I was like, honey, we have a consultation at Home Depot to just try and talk through what a kitchen looks like. So we're going there Sunday afternoon. She's like, slow down, champ. Yes, I said we're staying in the house, but we just sold our house in March. That was 3 months ago. Now we're not moving and now we're renovating. You gotta slow down. Plus, she also starts a new job next month.
The funny thing about being like this podcast host with you is I really feel a lot of what your wife feels. Like, I see you, Sarah. I feel you, because there are times where I like give an idea and then you go and do it. I'm like, whoa, wasn't ready yet. What do you mean? What? I can completely relate to that. All right.
Now, the reason I do that is because I internalize stuff a lot before I say it out loud. So I'm assuming once someone has said something out loud, they have thought through everything in their head about what that involves, have come up to a decision, and now they've verbalized it. I don't actually think that could be the start of someone's thought process, is verbalizing it. Which I know is most women. Like, let's talk about this. Let's talk it through. Let's talk about every avenue that could happen. Men don't do that. Like, you want to go do this? Yes, let's go do it now.
I think it depends on the man. I would say that I'm more the gas and my husband is the brake. He has to think through everything. Very different than you. You guys are like complete opposites.
We're also the business owners.
Yes.
I think that might come into it.
Yeah. Okay. Well, now we've gone on. Let's.
What? We haven't spoken in 2 weeks. We have another 15 minutes of highlights to go through. No. Yeah. What? Probably the viewers and listeners are like, all right, next.
Yeah, you guys. All right. They're probably like falling asleep from all the taxes. They're like, I didn't. What? Yeah.
All right. Just in case you missed him, this is Jordan with a disclaimer.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
All right. Thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, or you can watch the video version, which I think is better. And you can watch that on YouTube, LinkedIn, Spotify, potentially if we're linking the videos into there as well, and Instagram. If you want to send an email to the show and get your question featured, you can contact us at hello@playbookotw.com, and we'll see you next time.
Ciao.
What the? No toodles?